Good morning, everyone, and thank you for joining us on Polycab, India's first quarter financial year 2021 conference call. I hope you all are doing well. I am Gandharv Tongia, CFO at Polycab India Limited. On this call, we shall discuss the Q1FY21 results, which was approved in the board meeting held via video conference yesterday. We will be referring to the earnings presentation, financial results, and financial statements which are available on the stock exchanges as well as investor relations page of our website. It can also be downloaded through the link or QR code on slide 8 of earnings presentation. Joining me today from the management team, we have our Chairman and Managing Director, Mr. Inder Jaisinghani, and our Director, Mr. Shyamlal Bajaj, on the conference call. Let me now hand it over to our Chairman, Inder Bhai, for his comments.
Good morning, everyone. I hope that you and your families are safe and healthy. Quarter 1 was significantly impacted by the headwinds of the COVID-19. However, we saw progressive sign of improvement as the restriction in the movement eased and could improve further as India unlocked gradually. Despite challenges, we improved our liquidity position and remained profitable, which I believe is a strong sign of our organization capabilities. We continue to prioritize safety and the well-being of our employees, partners, and customers. Polycab is proactively supportive society and the communities across India. Our strength, coupled with new strategic initiative, will enable Polycab to maintain its dominant position in the wires and cable and expand presence in the electrical ecosystem. I now request Gandharv to take you through our earnings presentation. Thank you.
Thank you very much, Inder Bhai. As you all are aware, we are going through extraordinary times. But as always, let me try and provide you with a general overview before discussing the first quarter performance. We continue with all supportive measures I had highlighted in the previous quarter call. And in fact, we have only augmented it further with the help of several NGOs. Our efforts have been appreciated by many, including local administrations. From an operations standpoint, currently all our factories, warehouses, and offices are operational, adhering to relevant guidelines from local and national authorities. Our distribution channel is fully active, but the larger dealers, distributors, and retailers in metros and tier 1 towns continue to be impacted by the outbreak. On the macro front, it is a kind of mixed bag. While infrastructure and construction activities continue, which is a good sign, many projects are facing labor shortages, which is delaying the execution. Most of the offices of companies and large dealers are located in metros, and due to erratic lockdown, orders are not getting finalized at the pace it should. On the other hand, if we look at many high-frequency data points like power consumption, manufacturing PMI, or unemployment rates, there are clear signs of economic activity picking up. Even we are seeing good momentum in towns with less than 10 lakh population. Currently, the sales in large metros would be 30-40% of the normal levels, while in tier 2 towns and below, it would be close to 80%. Average normalization levels in tier 1 town is somewhere in between. This could possibly be because of relatively lesser impact of virus and higher movement of goods and people and ample availability of labor in these geographies versus metro due to migration. We closed June month with about 15% decline in sales on a year-on-year basis, while in July we are seeing slight growth at this juncture. Having said that, our assessment suggests that bulk of this could be attributed to pent-up demand and some stocking due to rising copper prices. The first wave of lockdown, which started in March, impacted demand as well as supply. As we started unlocking gradually around mid-May, trade sentiment temporarily improved and demand started progressing. However, the ongoing second wave of erratic micro lockdowns is breeding a lot of uncertainty. So we should wait for 1 or 2 quarters for a clear trend to emerge. But all in all, we are optimistic and we believe as and when economies start to unlock, the recovery will be faster than general anticipation. Going ahead, we expect every quarter to be better than the previous, assuming things don't drastically deteriorate. As I had mentioned in last quarter, we are undertaking several initiatives like conserving and augmenting our liquidity position through judicious cost management, deferring non-critical spends, and availing additional credit lines. The result of this is somewhat visible in our improved cash balances, working capital, and our overall financial position. Nevertheless, we truly believe there is always some space for further improvement, and accordingly, we have commissioned a strategic project partnering with a reputed strategic consultant to drive cost optimization across the organization. Now moving on to presentation with slide 4. For the quarter ended 30 Jan 2020, our consolidated revenue declined by 50% due to severe impact of COVID-19 and restriction of movement. Business for first 40-45 days was essentially lost due to lockdowns. EBITDA declined by 75% year-on-year with 571 bps lower margin versus last year due to adverse operating leverage. Our staff costs at rupees 812 million were lower 12% year-on-year, largely due to lower variable pay and incentives. A&P spends were curtailed given the virus outbreak and were meager 0.3% of sales. These spends may remain muted for the next 1 or 2 quarters depending on the market condition. However, over the midterm, it will be restored at normalized levels as we continue to invest behind our brands. Our higher finance costs emanate from borrowing availed by Riker and some credit lines we explored to improve liquidity position in near term. Other income was rupees 336 million for Q1. A detailed breakup of our other income and finance costs have been provided on slide 12 of our earnings presentation. Our profit before tax and exceptional items declined by 86% year-on-year. Our profit after tax at rupees 1.1 billion is lower by 13% year-on-year. I would like to highlight that the current quarter profit includes 3 one-offs. Number 1 refers to 839 million adjustment on account of a favorable order received from Income Tax Appellate Tribunal in the current quarter. Second refers to the interest on this particular order, which amounts to 164 million, which is sitting in other income. And third one pertains to gain on previously held equity interest in Riker amounting to 97 million, which is an exceptional item. The 3 adjustments are provided on slide 9 below the P&L. Adjusting for these normalized PAT would be about 75 million. Moving on to segment on slide 5. Wires and cable, which is our largest business, declined by 51% year-on-year in first quarter due to slowdown in economic activity on account of outbreak of virus. Rising commodity prices did provide some support in the last month, especially in wires, which is seeing very good growth. Sales to Dangote were nil in first quarter as the project in Nigeria is facing some execution delays due to COVID. Despite that, exports continue to show resilience and was over 2x the base quarter. Optical fiber cable business was insignificant during the quarter as the execution was delayed due to lockdown and subsequently due to onset of monsoon. The profitability in this segment was down due to adverse operating leverage. On slide 6, FMEG segment contributed 14% to our business in this quarter. The segment declined by 43% year-on-year in Q1. However, June month was flattish. Recovery in lighting and luminaries and agro pumps was relatively better. Sales during seasonal months for fan business, that is April and May, were lost. Segmental profitability was impacted by deleveraging. Some of our new launches planned in Q1 were deferred given the market environment, but we aim to push it into trade at an opportune time. While the consumer sentiment is weak at the moment, we will continue to strengthen our core capabilities and proposition to outperform the market. I am very pleased to highlight that during the quarter, our Polycab Experience Center in Mumbai received an award for Best Retail Store Design. Other segment, which is largely our strategic EPC business, witnessed a decline in revenue and margins due to delay in execution owing to lockdowns. I feel immensely proud to announce that Polycab recently received an award for Excellent Digital Infrastructure Company in the 5th International ICT Excellence Award 2020 held in Geneva. We will continue to scout for opportunities in large digital infrastructure projects, including smart cities, surveillance, BharatNet, and Digital Village. The consolidated financials of this quarter also reflect Riker Base, which is now a wholly owned subsidiary. Accordingly, we have created a new segment, Copper, and disclosed the financial results. However, the impact is insignificant at this stage. Moving on to financials, our balance sheet remains healthy with 2 billion of net cash position as of June 2020 versus 1.6 billion as of March 2020. We continue to work on our long-term strategic and structural initiatives and like increasing channel financing, inventory rationalization, debottlenecking of processes, increasing automation, augmenting supply chain operation with technology, and building data analytics capabilities. These initiatives, coupled with specialized support, will certainly help us improve efficiency and strengthen our market positioning. On the distribution side, our direct reach remains strong at over 3,500 authorized dealers and distributors across geographies. Retail outlets reach increased to over 130,000 as of June 2020. Incrementally, our focus is to drive reach in lower tier towns, semi-urban and rural, where our presence is limited at the moment. We have commenced a pilot project with the same agenda in mind. We continue to enhance our key influencer connect through Project Bandhan, which now has over 141,000 electricians and over 43,000 retailers on board. Lastly, I would like to re-emphasize on this fact that our company, brand, and fundamentals are well positioned to circumvent the ongoing challenges. We remain stubbornly optimistic of the medium to long-term development potential of our nation and the growth opportunities it offers, led by structural drivers and government push. But at the same time, we would be cautious and agile in our approach in order to deliver sustainable and profitable growth for all stakeholders. With this, I request the operators to open the line for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Atul Tiwari from Citigroup. Please go ahead.
Yeah, hello sir. Thanks a lot for the opportunity. Sir, I think you said that in the month of July so far you have seen some kind of marginal growth in top line. Could you give some more on your individual segments, especially the retail, B2B and exports? How are they panning out in the month of July on an individual basis? And what would be the blended capacity utilization in your plants as of now?
Thanks, Atul. Thanks a lot. Let me pick up your second question first. The capacity utilization as of now is hovering between 50% to 60%. And if there is a need, we can certainly increase the capacity utilization. On the first part, the B2C business is getting good traction from the market, which is retail wire as well as FMEG business. On the cable side, the institutional business is not gaining momentum at this stage because that's dependent on several factors, including signing off of projects, availability of decision makers in the offices, and so on and so forth, which is a bit erratic as of now because of lockdowns.
Okay, but on an overall basis, I got this part right, that so far in July, the top line has grown marginally year on year. It has not declined.
The other thing which is worth highlighting at this stage is export growth. I'm sure you would have noticed that in the first quarter, our exports grew almost by 100%. In the base quarter, it was almost 50 crore rupees, and now it's 100 crore rupees. An important thing is both of these balances do not include Dangote sales. So without Dangote, we have been able to increase exports. So that's helping, and we expect that it will continue to help. And the demand is broad-based, but particularly FMEG and B2C, which is retail wire, is helping us.
Okay, and just the last one. Obviously, in the month of July, we have seen some more lockdowns across various places in India at a localized level. So what is the color on that? I mean, has it significantly impacted your distribution and demand, or this is still manageable if it continues like this? So the point I'm trying to kind of get from you is that if these intermittent lockdowns continue, say for another 2-3 months, do you think that this flattish kind of revenue or some marginal increase in revenue will sustain, or we may dip into a year-on-year decline again?
That's very interesting one. Let me afford to be slightly a bit more optimistic now than what otherwise I should be there on the investors call. Let's understand what is the pattern in Q1. We lost almost 1.5 months to 2 months because there was a complete lockdown. I don't expect that would happen. Since last week or so, we are hearing about positive development on vaccine. And even if there are lockdowns, there are localized lockdowns. So my expectation is that things will only improve from here. Q2 is going to be better than Q1. But at the same time, I think we should be cognizant of the fact that even if there is a lockdown, which is a localized, it would have some bearing on the performance. So I don't expect an absolute growth coming in the immediate quarter. But my sense is Q2 is going to be better than Q1 at this stage. The other important thing is export market, where not necessarily lockdown is having severe impact, would probably help us. So overall, my sense is Q2 is going to be better than Q1, and H2 ideally should be significantly better than H1. Atul, I'm taking liberty at this stage. When the cost of being optimistic and cost of being pessimistic is same, it's better to be optimistic, right? So that is what I'm sharing with you as a friend.
No, great. See, to be very frank, in the first quarter, congratulations on managing your balance sheet and cash flows very well. P&L obviously, was widely expected will be weak, but balance sheet and cash flows did quite well in a very tough environment. So congrats on that.
Thank you. I'm glad that you're pleased.
Thank you. The next question is from the line of Aditya Bagul from Axis Capital. Please go ahead.
Hi Gandharv, hi Inder bhai. Good morning and congratulations on a good set of numbers. Sir, I have 3 questions, right? So let me take the first one. It's largely on export. So we've seen a spectacular increase there. I wanted to get your sense on what has led to this increase, especially given that Dangote execution has not happened this quarter. So what has led to it? What are the key markets and what are the key products? So something on that would be helpful.
Sure. Do you want to give me other 2 questions as well, and then I can take all at one go?
Fair enough. So the second question was with regards to our B2B business, which is your institutional business, cables business, projects business, etc. Just wanted to understand that all of these business, the execution has been largely stalled for the last 3 months and likely to be stalled for another couple of months. So just wanted to understand that how do we see whenever that implementation ball sort of begins to roll, do you believe that we get a demand in gusto wherein we get a huge pent-up demand towards September, October, and that will sort of fuel growth much more than what we lost out earlier? So that was question number 2. And question number 3 was largely on our long-term thoughts in terms of the FMEG. Because the other 2 pieces, right, our cables and wires business, both domestically and exports, is doing reasonably well, both in terms of top line and margin. So just wanted to get your 2 cents on how do you see the FMEG scale up, especially on the margin front.
Sure. Thanks a lot, Aditya. So let me go in the same order. Exports in this particular quarter has got support from geographies like US and Australia. In the base year, as I mentioned to Atul, it was almost closer to 50 crore rupees of export revenue. It's now almost 100 crore rupees. And I'm sure you are aware that recently we have incorporated subsidiaries in US and Australia, and these are going to work like trading arms of the group. In last few months, we have secured approvals from large key customers. For example, we have approvals from the metro companies in Australia, and there are similar several such examples. So the export business is looking positive. The only thing which we should bear in mind, and which is what I was alluding to in the previous question as well, that if there is a significant lockdown in any particular geography, for example in the US and Australia, which is of course beyond our control, it could have impact on bearing. But if I normalize that, the export is going to grow from here. The other important thing which is important to note at this stage is anti-China sentiment. Across the globe, the sentiments are against China, and that is helping us in improving, our overall traction in the market. If we take a very broad global macro view, if China is going to get a setback because of anti-China sentiment, then a country like India should get some advantage out of it. And we as a market leader in cable and wire business should be able to maximize growth from that avenue. So overall, export looks positive. Dangote, though we couldn't execute anything or supply anything in the quarter, but we expect in a quarter or two we would be able to conclude the contract depending on the things in the Nigeria, and that will help us in improving our export line or export top line further.
Sure. Gandharv, just one more point on the export business. Would the margins at the export level also be similar to 11 to 13% that we've guided?
Yes, broadly, it varies from product to product, but generally speaking, we can take that as a base.
Perfect.
Thank you. The next question.
Moving to there were a couple of other questions of Aditya. So the second part was on B2B, what we are seeing today. In the first quarter, we lost almost 80% of our institutional business because of impact on account of lockdown. I believe this will only improve from here. I know that decision making is impacted because of unavailability of key personnel in the offices for the large customers. But since slowly and gradually all of us have started going back to office, I expect this will only further improve. In few of the sectors, it could have slightly different reaction depending on liquidity, but we expect this will improve. I think Aditya was trying to understand specifically whether it will result into a specific pent-up demand in a particular month. At this stage, we cannot reject that possibility, but to my mind, that is dependent on the liquidity of the end customer, and it will vary from case to case. Third one, I think, was on FMEG profitability, and this lockdown has given us enough time to think about our strategy in FMEG. One thing which is very clear, we have to unlock the synergies, and as a step in that direction, we have decided to merge our switch gear business with wires business so that we have common agenda and we are able to consolidate and increase the cross-selling. The second thing is, and let me split it in two parts. Let's pick up the businesses which are slightly large, for example, fan business or lighting and luminaire business. There now the focus is twofold. One is we want to drive profitability. We are getting good traction in the top line, but the focus now is on profitability. And the second thing is we want to improve working capital significantly for these businesses. For inventories, we have already taken some steps, and we expect that will only improve on a go-forward basis, and the channel financing I expect will further increase there. On the smaller businesses, we will continue to drive our growth agenda. For example, pipe business, where we would like to get into 1 billion revenue or thereabout. Then the product augmentation. We talked about IoT and home automation and getting into PM categories. Most of these projects are available and will be launched in the immediate future. The another important thing is, though that's applicable at the company level, but that would also help in FMEG business, is around cost optimization. We are going to work with a large strategy firm which will help us in optimizing cost, and that will help all the businesses, including FMEG. I hope I have answered your questions, Aditya.
Yes, thank you. Thank you so much, Gandharv. I'll come back in the queue. Best of luck for the quarters to come.
Thank you. The next question is from the line of Ashish Poddar from Anand Rathi. Please go ahead.
Yeah, many congratulations on inline results. Though my most I'll ask on more on the strategy side. So we are focusing more on the liquidity, cash balance, anything. Even in the last quarter, I saw some capex of around 25 crores. If you can explain where has it happened?
So this is actually in continuation to our last year's capex. We had decided to incur almost 300 crore rupees of capex in the last year. Actual capex was closer to 270-275 crore rupees, and that amount has been incurred in the first quarter. In this year, we believe that our number closer to 200 crore rupees or thereabout should be okay, but we will revise it upwards if there is an improvement in demand. And this capex is being utilized for broadly three things. One is debottlenecking for cable and wire business, additional capacities for FMEG business, for example, fans. And third is for export business. There is some modification which is required in our machineries, including some new machineries, so as to maintain and meet the requirements which are there in those geographies. So these are the broad three categories where we are spending capex.
So you're saying this year it will be minimum 200 crore?
Yeah, at this stage it looks like around 200 crore rupees, but we will continue to monitor it, and if we get better than results in the subsequent quarters, we will probably revise it upwards.
Got it. Thank you and all the best.
Thank you very much.
Thank you. The next question is from the line of Sonali Salgaonkar from Jefferies India. Please go ahead.
So thank you for the opportunity. So my first question is regarding the industry. So you mentioned that, July you saw a slight growth in the top line. So export market, purely from the domestic point of view, are you seeing things improving, which could have contributed to the growth in your top line?
Yes, Sonali, that's true. Things are improving. The only thing which I highlighted in my opening remarks as well, that whatever we are seeing has an element of pent-up demand. And at this stage, it's very difficult to segregate what is pent-up demand and what is the underlying growth. I think we'll have to wait for a quarter or so to get to a clear view on this, but as of now, things are apparently improving.
Understand. So my second question is regarding construction activity. Now we understand that the key driver for cables and wires, the B2B business, would be largely construction. As we understand, the offtake is not happening as much in the urban areas, but just wanted your view on how are you seeing construction activity shaping up metros?
That's an interesting one, Sonali. In fact, what we are noticing slowly and gradually, construction activities are improving in tier 2 towns, tier 1 towns because of availability of labor. And I think largely these geographies are not severely impacted by COVID. So that's good. In fact, our proportion of tier 1 and tier 2 towns has increased in the current period. Tier 1, tier 2 probably would have contributed almost 40% to our channel sales in the base quarter, which has increased almost to 55% in this quarter. And if trend continues, this will improve further. And because of this and otherwise as a part of our strategic initiative, we have now hired another consultant who is helping us in penetrating these geographies. And we are going to pilot new initiatives in select geographies in 3 states in next 2-3 months to see how we can further improve our penetration in these markets and take all the products of Polycab to the end customer.
Understand. So my third question is regarding, again, from the industry perspective, the inventories in the channels. Now we understand that because of the lockdown imposed in March, there were a higher amount of inventory starting of April. So could you just give us an update on whether the channels have completely liquidated the inventories or there are still some lying around?
So March inventories have been fully liquidated. In fact, in the June, there was a significant increase in copper prices, which led into some sort of a stockpile up at the dealer's end, and slowly and gradually that is going down. In fact, our sales, to be very precise, was comparatively better in the first fortnight of June month, and second fortnight it started going down after we revised our prices upwards because of improvement in copper prices. So as of now, while we are speaking today, it has started inching towards normalcy, and from now it will only improve.
Understand. So, and lastly, any thoughts on the upcoming festive season? This is particularly from the point of view of our appliances. So, and one last question, if I may squeeze in. Any impact from China or any big imports from China which you think you could de-risk from? That's all from my side. Thank you.
Yeah, so let me pick up China first. We don't have any dependence or any significant dependence on China. If I talk about cable and wire business, most of the materials are either sourced from countries like Japan or domestically, if I talk about metal consumption. And in non-metal, we have negligible dependence on China, where we have alternate supplies already available domestically as well as across the globe. So that there is no dependence there. And in FMEG, we are uniquely placed because all along we always believed in Make in India, and we have almost everything manufactured inside within the company. So that's positive, unlike few of the other players in the industry. For few of the SKUs in fan business, particularly premium fan, we have some dependence, but the contribution of that would be hardly anything. And for that also we have alternate supplies available in India as well as in countries like Taiwan and others. So overall my sense is it would be less than 1% or probably even lesser than that as far as China dependence on the procurement side is there. On the sales side, as I explained to Aditya a while back, it will probably help us in improving our exports. So that's going to be slightly positive for us. On your first question, sorry, I forgot the first question, so I'll let you repeat.
So your thoughts on the upcoming festive season? Are you expecting a lot of demand, a lot of pent-up demand to be unleashed, especially into your FMEG categories?
Broadly, directionally, the sales pattern should increase slowly and gradually in the subsequent quarters. Now, the festive things are dependent on how good or bad the condition is, right? So, for a few of the religions, even this period is also festive, but because of COVID, I don't think they can step out and carry out celebrations. So, if things improve on the COVID front, certainly it will help us in improving our top line.
Understand, sir. And are you seeing any excessive discounting in the industry in any particular category?
No, not at this stage.
Thank you, sir.
Thank you, Sonali.
Thank you. A reminder to the participants, please limit your questions to per participant. Should you have any follow-up, request you to rejoin the queue, please. The next question is from the line of Amit Mahawar from Edelweiss. Please go ahead.
Yeah, hi, good morning. I just have two specific questions. The first one is maybe for you. What's our FY21 focus in terms of specifically our working capital profile and balance sheet quality, very specifically? And second question is more for Inder Bhai. I can understand how do we look at exports because capacity availability is pretty high for us. Domestic retail demand, especially in wires, it seems to be pretty on a weak wicket. So how far can we go on exports? And if I can also touch upon the global dynamics in terms of competing countries, which basically we have to keep in mind. So these are two specific questions. Thank you.
Thank you, Amit. So on balance sheet, there are two development needs which we have, if I may use those words. One is we have to further optimize the inventory level. And in the last call, I had mentioned that we are working with one of the consultants to optimize the inventory, and we want to do two things. One is we want to reduce the overall amount, and within the reduced amount, we want to increase the number of SKUs which are available. So that's moving in the right direction. In fact, if you recollect, in the first 3 quarters of last fiscal, the inventory was slightly looking better than the year before that. In the fourth quarter, we got some impact because of COVID, but from there it is only improving. If you dissect our inventory numbers, we have been able to optimize the inventory at FG level. At the RM level, there is some higher level of inventory because of goods in transit. So directionally, we believe that we have to further optimize the inventory, and it will only improve from here onwards. On the receivables, the channel financing in cable and wire business is in mid-60s. Which can slightly go up, and in the case of FMEG, it can significantly go up, and that is where we'll continue to remain focused. So that is how we will be able to improve the working capital. Before I answer your exports related specific question, wire, though there was a degrowth, but the degrowth was not as significant as what we noticed in the cable business. Cable got severely impacted because of absence of institutional business. Institutional business almost degrew by 80% or thereabout, and wire business didn't degrew at that rate. Exports, there are 2-3 things which we are trying to do. One is we have identified 10 geographies or customer sectors where we want to penetrate. And in that direction, we have taken steps by incorporating subsidiaries in Australia as well as in the US, and will continue to further augment. The utilization is not directly comparable because in few of the product categories, specifications are different, and not necessarily the same machineries can be used for producing the output which is required for the export businesses. Over the mid to term, we would like to have at least 10% of revenue coming from export business.
Okay, and maybe lastly on just on the same question, some dynamics with respect to which are the competing markets where we face competition and supplies of cables, especially the industrial and utility cables.
So in the cables, there are opportunities available in several geographies. As I mentioned, a couple of them. There are geographies available, for example, Africa, where lots of World Bank projects are getting implemented. And in these projects, Amit, the important thing is there is no import duty, and that is where an exporter from a country like India is comparatively on better footing. So these are the geographies which are available. Around 10 to 12 geographies of customer sectors you can build in, and that is where we'll continue to work in the quarters to come. And on the products will continue to be LV and MV.
Okay, thanks, Sandhar.
Thank you. A reminder to the participants, please limit your questions to 2 per participant. The next question is from the line of Aditya Bhartiya from Investec. Please go ahead.
Hi, Gandharv. Good morning.
Good morning.
You mentioned that channel financing proportion for wires and cables would possibly be somewhere around mid-60s, and for FMEG business it's likely to be lower. Could you just give us an indication how this would have stood maybe 4 to 5 years back?
It was almost nil 5 years back.
Understood. And on the power cable side, is it possible to share the proportion of cable sales that come from power ACBs?
Our business model. So, what we do is almost 80% of our business comes from distribution, and distribution or dealers and distributors, they in turn supply to the end customer. So for us, it would be very difficult to give you that bifurcation.
Understood. Perfect. Thanks a lot, Gandharv.
You're welcome.
Thank you. The next question is from the line of Chintan Sheth from Samiksha Capital. Please go ahead.
Thanks for the opportunity, and congrats for the good set of numbers. On the industry side, cables and wires, how the industry has grown, or compared to industry, how I just wanted to understand the relative performance of Polycab. That is one. And second, on the FMEG side, if I look at our growth, we did, you said lighting and agri pumps are doing better. Fans lost the peak season. How are things on other product categories? You mentioned pipes, you want a 1 billion target. By when you are targeting that?
Yeah.
And similar guidance on the longer term, what's our target in terms of each product category revenue?
Thanks, Chintan. So the first one at the industry level, I think almost everyone has degrown in this particular quarter because of lockdown. The impact has been more severe for the unorganized players because of unavailability of funding and other associated issues. We'll have to wait for other companies to declare their results, and then we can take a view on the industry degrowth. On FMEG, I think directly 2 things which are important for us. One is in whichever business category we are, we want to be market leader. We have to reach into top 3 and eventually to move towards number 1 position. As I explained a while back, there are 2 things which we are trying to focus on. The businesses which are slightly larger within the FMEG business, we want to increase the profitability there and improve the working capital so that we can improve the overall ROCE, return on capital employed. And for the smaller businesses, we want to increase the growth rate and first get them into 100 crore club, and from there then we want to monitor their growth on the financial metrics.
Right. So 100 crore for pipes. What are the target? Where are we right now in terms of fans, lighting, and switchgear? If you can, or your near-term or medium-term target in terms of revenue.
No, I won't be able to give you a number. As a company, we are not giving guidance. I can share with you a directional thought process, what we want to achieve. And that remains that for the large businesses, we want to improve the profitability and improve the ROCE by optimizing the capital employed in those businesses. And for the smaller businesses, we want to further up the growth rate in top line.
Okay, and lastly,
that doesn't mean that the growth will come at the cost of profitability. Profitability would certainly be there, but once you reach to a stage, you can further improve the profitability. And this project on cost optimization which we are doing will certainly help us in further augmenting the profitability.
Sure. And lastly, if I may, on the regional mix, how the revenue has moved from, West already impacted because large market like Maharashtra has been, under severe lockdown. How that revenue mix has moved and where geographically where the growth is coming from. You mentioned Tier 2 has been growing faster, but if you can provide north, south, east, west, where the growth is coming.
So let's split that into business. If I talk about cable LDC business and to a great extent wire business, the degrowth is across all the quarters almost in the similar range. In the case of FMEG business, South and East would have degrown by 20 to 30%, and North and West would have degrown by 50 to 60%.
Sure. And how they are panning now currently?
So as of now, almost all the regions are showing signs of recovery.
Southeast may be faster compared to Northwest?
I think 20 days data is not necessarily good enough to reach to that conclusion. We'll have to wait for at least a month and 2 before we conclude.
No, I was just thinking about June and July, not the only July number. June, how has been the response?
Yeah, I think we'll have to wait for a month or 2 before we conclude and comment on July performance.
Sure. I'll join back in. Thank you, Gandham.
Thank you.
Thank you. The next question is from the line of Sabyasachi Mukherjee from Centrum PMS. Please go ahead.
Hello. Yeah, am I audible?
Yes, you are audible. Please go ahead.
Yeah. So 2 questions from my side. First of all, you said that Insta business continue to remain weak. If you can split between the government and private entities, the reason behind asking such question is few weeks ago, government actually pushed the public entities to announce their capex plans, and I think if that has anything to do with on the order inflow and order finalization.
Sure. So we as a company directly, we don't deal with the government customers. It makes our on annualized basis contribution of government customers to our top line would be around 1 or 2% or 3%, not more. Our dealers and distributors certainly supply to government. On the private, we have sizable customers available, but it's quite possible that they in turn are also executing large government orders. And both the businesses put together has degrown significantly in this particular quarter by almost 80%. And as I mentioned in my opening remarks, it is expected that the recovery should start soon because most of the offices have started resuming and decision making probably will start happening.
Okay. Second one on the industry. Even at pre-COVID situation, we saw industry declining in double digits in the last financial year. In every quarter, it was declining. what is the near-term and medium-term outlook from your side on the industry, and what kind of are you seeing any kind of consolidation happening in the industry?
So if we dissect the industry growth rate or degrowth rate over the last few quarters, predominantly the growth or degrowth, in fact in this case only degrowth, is coming from unorganized sector. The large players are able to either maintain their market position or are able to, and we are no exception to that. We have been able to improve our market positioning. We believe that because of GST, demonetization, as well as liquidity crisis, which was witnessed in last fiscal, will probably increase the proportion of organized business in this particular industry, and that is where a large player like us would gain out of it. Over the midterm, generally this industry grows at 1.5x to 2x of GDP growth rate, and that is how we should see the growth coming at the industry level.
Okay. Last question, if I can squeeze in on the financials. I was just seeing your operating cash flow of almost 300 crores this quarter. Was just trying to add things up from EBITDA to cash flow from operations. I was seeing almost a 140 crore dip in the other current assets. Apart from that, inventory, receivables, and creditors were almost offsetting each other here and there. This 140 crore dip in other current assets, anything specific over there?
So, when we procure our metals, for example, copper, it has an element of embedded derivatives, which is as of the balance sheet date required to be valued and classified as per the nature. For all practical purposes, you can treat it as a trade payable. This is an accounting adjustment which is required to comply with the IFRS requirement, but practically it is nothing else but a trade payable. So on overall basis, broadly, if I give you numbers, our receivables has given us around 200 crore rupees of cash in the cash flow statement, partly offsetted by around 63 crore rupees of inventory increase, and trade payables, including this derivative element which I have talked about, has given us around 120 crore rupees, which is then offsetted by almost 35 crore rupees of tax outflow. So overall, the number is around closer to 300 crore rupees.
Okay. Thanks a lot. One question on the fixed assets. I see almost 250 crores of jump. Is it because of Riker consolidation?
That's right. That's true. Riker used to be a joint venture till 6th of May, and we were following equity accounting as of 31st of March. Since now it's a wholly owned subsidiary, we are required to do line-by-line consolidation, and that is why this number has increased.
Great. Thank you. Thanks a lot. That's all from me.
You're welcome.
Thank you. A reminder to the participants, please limit your questions to 2 per participant. The next question is from the line of Mayank Bhandari from B&K Securities. Please go ahead.
Thanks for the opportunity. Sir, I wanted to understand, as you highlighted that this year CapEx is going to be about 200 crore. Sir, how much you are going to spend on the fans particularly?
Broadly, you can take around 35% amount will be invested in FMEG and balance will be utilized for cable and wire business.
The 35% will go on FMEG?
Yes, that's true.
As you highlighted, sir, in normal base quarter, 40% almost is coming from tier 1 and tier 2. So how much will be from the metro cities?
So in the base quarter, contribution of metro cities to the top line was closer to 60%, which has now reduced to almost 45%.
Okay, so 60% of metro and 40% tier 1, tier 2 as you have classified.
That's right.
Okay, sir. Thanks.
Thank you. The next question is from the line of Achal Lohade from JM Financial. Please go ahead.
Yeah, thank you for the opportunity. My first question was, would it be possible for you to give a mix in terms of wires specifically for the first quarter FY21 and last year same quarter?
So wires and FMEG both put together constitute B2C for our purposes, and that has significantly increased. In the base quarter, it was closer to 35%, and it is now around 43%.
But you won't be able to separate it out in terms of wires specifically?
Yes, that is not being disclosed formally now.
Got it. And the second question I had is, given Mr. Ramakrishnan has moved out, is there any change in terms of the management for the FMEG and the other businesses?
So Ram joined us in 2011, and he was instrumental in shaping Polycab version 2.0. And over the period, we have hired several business managers and inducted them into our leadership team. In fact, as a matter of fact, probably today we would have almost 40-45 individuals who are drawing more than 1 crore rupees of salary. Idea is not to highlight their salary. Idea is to highlight the quality of talent which we have inducted in our leadership team. And these persons are responsible for day-to-day operations of the company under the guidance of chairman and main director as well as of the board. In 2018, as part of succession planning, Ram stepped down from the board as well as joint managing director and continued as a mentor to these business leaders who were inducted as well as to the second generation of the promoter family, and he ceased to be a KMP in 2018. And since then, these managers are managing the business, and I must say that they are doing a well job at this stage. Few months back, Ram, as he was about to attain his superannuation age, he wanted to devote more time for social welfare, and he wanted to complete his PhD, which is known to few of you already. So he decided to leave the company, and 30th of June was his last working day with the company. And as I mentioned that he was in mentor's role since 2018, and the large leadership team, any which ways of managing the business, there is no impact on the business because of Ram's exit from the company. And certainly we value Ram's contribution to Polycab over the years.
Got it. Great. Thank you so much.
You are welcome.
Thank you. The next question is from the line of Anand Singh from Unifi Capital. Please go ahead. Anand Singh, your line is in talk mode. Kindly go ahead with your question.
Yeah, thank you for the opportunity. Just wanted to come back to the export potential. Now, you mentioned our target is to have 10% revenue from export over the medium term. For that, I imagine it's like 2 to 3 years. Is my understanding correct?
Between 3 to 5 years is broadly I would like to peg at this time.
Yeah. So for 3 to 5 years, 10%, given that we are talking about shifting of interest towards India from China for the rest of the world, is that 10% goal in 3 to 5 years, is that our base case expectation, or is this a kind of optimistic, or is this, I'm just trying to understand how should I kind of put it in the context that the opportunity size is huge, and we are just talking about number over 5-10 years, 3 to 5 years of 10%. So why is it the guidance that you are kind of giving is relatively subdued with respect to the opportunity globally available?
So Anand, you know this company already. We have always given a guidance, and generally we have delivered a better performance, and that is why we believe that 10% is a good number to talk about. And you and me are any which way are going to exchange notes on quarterly basis and yearly basis, so we can always revisit on the basis of actual numbers. And in terms of margins, given that this will be mostly a B2B business when we do exports, it's a fair bit lower margin as compared to domestic business. Is that the expectation here? No, it's fairly comparable. Okay, so very similar to the overall business margins in India that we have, same we can do in exports. Yeah. Okay, thank you. I'll come back in the queue.
Thank you. The next question is from the line of Ashish Jain from Macquarie. Please go ahead.
Yeah, hi, sir. Thanks for taking my question. So my question is on, again, the cables and wires business. One is, is wires now contributing like 1/3 of our cables and wires segment? Can you just confirm or comment on that?
So wires and FMEG both put together constitute B2C segment for our internal analysis, which is almost 43%. Earlier it used to be around 35% or thereabout.
Understood. Sir, and you spoke about, wires doing much better than cables during the current quarter at least. Is that a trend in specific regions or geographies, and are you seeing that trend, improving as we speak? If you can just give some color on what led to a better performance in wires, because I thought, even that is very closely linked to new construction. So what really led to the surprise in your view?
So cable, as I mentioned and alluded to, that in the case of cable institutional business, there was a significant element of degrowth, which has impacted the cable business growth. In the case of wire, the growth or degrowth is consistent across all the regions. There is no one particular region which is doing better or worse than others.
Understood. Okay, sir. Thank you so much.
You are welcome.
Thank you. The next question is from the line of Chetan Gindodia from Alpha Accurate Advisors. Please go ahead.
Hello, and congratulations on the excellent set of numbers. So, my question is more on the institutional cable business. So, institutional cable business would now be contributing so 43% is wires and FMEG. So, rest of it would be most of it would be institutional cable. Is my understanding correct? And secondly, what would be the driver for institutional cable business to improve from here? Is it only the faster decision making that might be the driver here that might lead to the increase? And especially with most of the companies cutting down on their capex in FY21, so is the outlook likely to remain subdued due to lower new projects?
Yeah. So I think let me just take a step back and explain you the business model. We are not a typical B2B company. 80% of our business comes from distribution, which is true for cable as well as wire as well as for FMEG. So when I'm talking about institutional, this is only balanced 20-25% or 15% of institutional business, which has degrown. A distribution business is totally different than institutional business. The private capex is one of the drivers. Yeah, of course, the government capex is important. But there are things like BharatNet project, and all of us are aware that government wants to improve digitalization and get connectivity to each and every village of the country. So if a country wants to get to that level of digitalization, the government and private capex will continue, and that will help us in improving our top line. So overall, the business growth will come, but we are not only dependent on institutional cable business.
Oh, thank you.
Thank you. The next question is from the line of Prashant Kutty from Sundaram Mutual Fund. Please go ahead.
Yeah, thank you for the opportunity, sir. Sorry, I think I've clarified it enough number of times in terms of the cables and wires business. But just to probably for the sake of this reiteration, and apologies if I'm repetitive. While you said that 45% of our business is the wires business and FMEG business, and I assume exports is also growing at an exponential pace. The institutional part of the business, or let's say the rest of the business, whichever is X of wires and FMEG, what would be the kind of decline we are running at as far as that part of the business is concerned? Let's say as of June, July is concerned. Could you just give us some sense on that?
So for the first quarter, minus that business across product category, that number would range between 40% to 50-60%.
And like you said, that if that number has been improving, has July kind of improved from that minus 40 to, let's say, an improving number, or is it still where it is?
I think for July, 20 days are not good enough to reach to a conclusion. My suggestion is I think we should wait for a quarter. In the next quarterly call, we can deep dive into Q2 performance.
Okay. No, the reason I asked is because did you make a comment in the start of the call that you are actually seeing growth in July. That's the reason as to why I asked.
Yeah, that's right. That's
Okay.
right.
So
Overall, at overall level, July month is so far is positive on the basis of 2021 days revenue.
Okay. Fine. Sure. Thank you so much.
You're welcome.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question. I now hand the conference over to Mr. Gandharv Tongia for closing comments.
Thank you, operator. Thank you all the participants for your time. In case if you have any question, you can always write to investors.relations@polycab.com. I hope all of you stay safe. Take care. Bye-bye.
Thank you.